Hello and welcome to this session in which we will discuss earnings quality and ratio reliability. In the prior session, we discussed limitation of ratio analysis. This session is an extension of the prior session because when we end up the prior session, I said we are going to discuss earnings quality as it affects financial ratios. But since earnings quality, in my opinion, a concept that is important enough, I decided to devote one whole session for earnings quality. Then we will go back and we'll see how earnings quality and ratio reliability are part of this limitation of ratio analysis. So what is earnings quality? Earnings quality evaluate how dependable and meaningful reported earnings are a reflection of the firm's financial performance. Okay, the company reported 5 billion in net income. How dependable, how reliable, not how accurate, the number is accurate, but is this number going to repeat itself next year? Is this a one-time thing that, if we take one transaction out, revenue would be, net income would have been 2 billion. For example, there's a 3 billion transaction here. Or maybe 25% of the reported net income will not repeat. What is the quality of this earning? How good is it? Is it generated from actual repeat business, or is it due to maybe accounting gimmicks, changing an accounting principle? This is what we mean by earnings quality. Poor earnings quality can diminish the effectiveness of the ratios by creating volatility or providing misleading insight. So if this number, if this 5 billion figure does not reflect good earnings quality. Now, what's good earnings quality? We're going to see some qualitative characteristic of this. Just know good versus poor. If it's a good earning quality, then we can rely on it. And if we can rely on it, it will generate better financial ratios. That's the idea. So this is what we will discuss in this session. Let's go ahead and get started.
Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
So what is a good indicator of a quality earnings? One is consistency of earnings. That's very important. That's the number one factor. What is consistency of earnings? Consistency in earnings, or of earnings, or in earnings enhances quality by providing stable and predictable basis for analysis. Firms with high variability in earnings are considered to have low quality earnings. So what do we want to have? We want to have stable and hopefully stable and going upward earnings, stable and upward over the years, versus variability in earnings. High variability, it's high variability, more risk in the first place, but two, when it comes to ratios, we cannot rely on high variability as much. So make a single year analysis unreliable when you have high variability. Remember that 5 billion? Well, if it's a one time of deal, and in the subsequent years I'm going to have 2 or 1 or 3 billion versus 5, that's not reliable. So is it highly variable, or is my profit, is my earning reliable? For example, let's look at two firms. Each reported 1 million in annual net income over a 5-year period on average. Firm A reported stable income of 1 million annually, while firms B reported earnings ranging from 0.2 million to 2.5 million. Well, what do we say? We say firms A earnings quality is higher because it's stable, it's more indicative, it's more predictive. So we can build ratios and be comfortable that these ratios are more meaningful than the ratios for company B. Now, bear in mind, some companies in some industries, that's the nature of their business. For example, if you have a construction companies rely on large contract that comes every once in a while. And those contracts are irregular. They are a regular project. And what's going to happen in certain years, you're going to have more profit than other years. That's fine. But you have to take that into account. So a construction company is different than Walmart. Walmart is a retailer. It's a supermarket. The supermarket revenue should be stable and going up versus a construction company, it should fluctuate. Now, just because the revenue fluctuate, now we could also look at the volatility of that fluctuation from the construction company to make a better decision. So a single year profit margin might suggest strong profitability, but it would not be reflecting long-term performance. So not only we only look at 1 year. If it's a construction company, we want to talk to management. If you're the analyst, you want to talk to management. Tell them, look, I understand you did good this 1 year. Would you attribute this to one contract that's not repeating, or would you think these contracts would repeat down the road? And they will tell you if they want their information to be public. In a sense, if they are publicly traded company, they'll have to tell you because their stock is publicly traded and it's in their best interest to be transparent. So what I'm trying to say is some companies by nature, their income is not highly variable. That's fine, but also we can measure that variability. Another aspect, and we discussed it in the prior session, accounting principle and earning quality. The choice of accounting principle will impact the perceived quality of earnings, not only the ratios, also the quality of earnings. For example, depreciation method. The double declining or the declining balance depreciation method, which is an accelerated method, they recognize more expenses upfront. Okay, providing a conservative view of earnings. So if a company is using accelerated depreciation versus straight line, accelerated, it means they are depreciating more upfront. They are reporting less earnings now. Later on, they have less expenses. Their earnings, their profit should be higher. We would consider this more reliable, of a higher earnings quality, versus a company that's using a straight line method. A firm using declining balance depreciation might report lower net income early in the years because they take more depreciation, but this enhances earning quality by reducing future write-off because you have less expenses. When it comes to inventory, under inflationary condition, what's inflationary? Inflationary when prices are going up, the cost of things are going up. LIFO, if the company is using last in first out, is better, produces a higher quality earnings. Why? If you're using LIFO, if prices are rising, it means whatever you are buying last will have a higher prices. Also, whatever you're selling last will have a high prices as well. So you are matching high prices, high cost with high sales, and recent cost with recent sales is a good indication of the profitability of the company. Versus if a company is using FIFO, what they will be doing, they will be using recent selling prices versus old cost. Old cost is supposedly to be lower if we are going through inflation, because inflation prices go up. If you are matching your recent sales with old costs, you're going to show more profit. That profit is not sustainable. The quality of your earnings are not as good as if you're using LIFO. LIFO might show lower profit, but it's providing a realistic view of profitability, not an inflated view of profitability. So if inflation drives up inventory cost, a firm using LIFO would report lower profit. You would say that's bad, but that lower profit is more accurate depiction of earning, gives you higher earning quality. In contrast, FIFO would inflate profit by matching older lower cost with current revenue. So again, in inflation, use LIFO, it's a better earnings quality. We have another term we need to be familiar with. It's called earnings power. Earnings power represents a firm ability to reliably generate consistent cash flow through operation. So what does it mean? We said earning quality is how good is your earnings overall. Earnings power is how good are you generating cash flow from operation. Because where else can you generate cash flow? You can generate cash flow from financing. What does it mean? When you want to get cash flow, remember the statement of cash flow has an operating section, a financing, and investing. Hopefully you remember those three. We say a company has a high earning powers when the cash flow is coming from operating, not financing. It means people are not giving you loans or they're giving you money through stocks, and obviously not investing. Investing means you're selling your property, plant, and equipment, and you're selling your investments. You really don't want to do that. So we say a company with a high earnings power when the cash flow is coming from operating. So this is vital for evaluating the firm ability to sustain its operation and meet financial obligation. Because to be stable, for your earnings to be stable, you want to finance yourself from your own operation. Rent, insurance, other recurring expenses. You want to pay those from revenue, from cash revenue. Long-term debt, you want to pay the interest and the debt from operating the business. And you want to pay dividend from operating the business. And earnings power is what? I want you to think of this. You as an individual, you want to have earnings power. Earnings power, think of you have a full-time job, which is if you have a full-time job, you're an employee, that's good, you are guaranteed. That's power. Power in terms of earning because it's consistent. And you might have a part-time job. Your part-time job, if you're selling something, it might be variable. If let's assume you are driving an Uber as a part-time, well, your revenue will go up and down. We would say, for example, looking at this analogy, your full-time job has more earnings power because it's more stable. That's your main source of revenue. You don't want to rely on your part-time. It's an addition. But this is what we mean by earnings power. Accounting policies differences that also influence earnings quality and financial ratios as well, because when firms adopt different accounting policies or change them, and we talked about accounting policies, for example, different policies across firms, companies may choose varying policies for depreciation, inventory, revenue recognition, account receivable, write-off, contingent liabilities, so on and so forth. These differences can impact financial ratios, and we talked about this, and can impact earnings quality. It can impact profitability of the company. It could impact its liquidity. So accounting policies play a difference. For example, makes a difference. Company Z switches to LIFO to better match current costs with current revenue during inflation. Well, as a result, the gross profit goes down and profitability ratios are adversely affected because you have lower profit. What does that mean? It means when you're looking at the ratios, see if the company made a change in policy. And as a result of this change, really the ratios did not change. What really changed the policy that changed the ratio. So you would not say the company is doing worse because their profitability ratio went down. Their profitability ratios went down because they changed the policy. So they're still operating as is. If you liked them last year, you should like them this year. All what changed is how they account for their cost of goods sold. Let's go back to inflation. Impact of inflation on ratios. Inflation, what's inflation? Inflation with the cost of things going up. Inflation can significantly distort ratio analysis and earnings quality by affecting both the value of the financial statement element and the economic environment in which the company operates. For example, looking at interest rate and debt value. Inflation is often accompanied by high interest rate. When we have high inflation, we have high interest rate, which reduce the present value of long-term debt with fixed interest payments. So if a company has a loan or any long-term payment, from financial accounting, what did we learn? We learned that a loan is reported at the present value of those future payment. So if I means the interest rate went up, the present value of the loan goes down because you are discounting those payments. This effect can improve leverage ratio even though the firm's actual financial health did not improve. So if you have a fixed payment, a fixed debt, a lease, a loan, a bond, and interest rate went up, the present value of your loan gained value. And obviously the opposite is true. For example, a firm's outstanding bonds pays 5% and the inflation drives market rate to 8, the bond's market value increase, you might say, but that's not good. It's good. Actually, it's good for you because now it's worth less. You can pay it off at a lower rate. However, this reduction is not reflected on the firm's balance sheet, which continue to report that at its historical cost. So although you benefited, but you cannot report it. Therefore, it doesn't show on the financial ratios. Another impact of inflation is when you have property, plant, and equipment like, machinery, vehicles, warehouses, so on and so forth. Those are reported at historical cost, especially in the US. We use generally accepted accounting principle and we report those at historical cost. If we have inflation, the fair value of these assets, they go up because property, plant, and equipment, usually they are anti-inflationary. It means even though inflation went up, they go up with inflation. They're not affected. They may rise significantly, leading to understated asset value and distorted ratios like return on asset. So their value went up in reality, but you don't report them at fair market value. For example, a manufacturing firm purchased a building for $2 million in 2005. Its fair value in 2029 is $5 million. You would still report it at $2 million. So when you run your ratios, you're reporting your ratios at $2 million. Now, because you're reporting at $2 million, you're going to show you're making good profit. Like you have a high return on asset, but the reality it's not. It's because you're using historical cost. Also, what could distort ratios as historical analysis and trend? Current performance and trend must be analyzed over multiple years to ensure accuracy interpretation. So also when you're doing ratios, remember you have to do them over several years. Now, if you don't have enough data over several years, those ratios are not good, or the data is not complete, it could lead to flawed conclusion. So if a retailer reported an unusually high profit margin during a single year due to a one-year event like they sold a major asset, analysts may misinterpret this as a sustainable improvement, but usually they don't. Usually analysts will ask questions, but you have to be careful about unusual trend in certain years. Seasonal factors could play a role in financial reporting. Seasonal fluctuation in operation can distort ratio if year-end balances do not reflect average performance during the year. So you really want to use average performance. So toy manufacturers may report low inventory level and high receivable at year-end due to holiday sales. Why? Because that's the nature of the business. They have less inventory and more receivable. Well, ratios like inventory turnover and receivable may not be accurately reflecting the firm performance over the whole year. Therefore, you would use averages to kind of fix those ratios a little bit. And usually when we look at the balance sheet, always when we have a balance sheet in the denominator, we use the average, generally speaking. Fiscal year differences, when you're comparing two companies, you have to make sure they're using the same year or the same 12 months. The fiscal year end for different firms may vary, complicating direct comparison. Performance matrix can fluctuate based on the timing of seasonal factors or economic conditions. For example, Company A fiscal year ends in December, which is the calendar year, while Company B ends in June. A downturn in demand during the winter may not appear in Company's B year-end financial, leading to misleading comparison. Just to be careful when you're comparing two companies, so they have the same fiscal year or calendar year. If not, you have to make adjustments. Also, you have to make adjustments for geographical and regulatory differences depending on where that firm is operating. Firms operating in different regions face different labor costs, and that's why, for example, companies move to China for that reason, because they have a low labor cost, or Vietnam. Tax structure and regulation affecting their financial performance. So if the same company is one operating in China, one operating in the US, and you're comparing them, you can't really compare them for many reasons, and one of them is labor cost. For example, a company operating with a lower labor cost, let's say China for the sake of illustration, may report a higher profit. Although China is no longer a low labor market, they will show a higher profit margin than a competitor operating in a high wage country, even though both have similar operational efficiency. So those are some of the factors that you need to be familiar with, that they affect ratio analysis and they influence the earnings quality of the company. Now let's take a look at a multiple choice question from farhatlectures.com. Firms report significant one-time gain in a fiscal year. How does this affect the interpretation of earnings quality? And a case in point is Caterpillar. Caterpillar in 1 year, 25% of their revenue came from Brazil. From one contract, their total earnings, 25% of their total profit or earnings came from Brazil, but that was a one-time contract. And guess what they did? They did not really disclose it properly. It should have been disclosed, but the point is something like this. So how does this affect interpretation of earnings quality? A, it increases earning quality due to higher net income. No, it doesn't. It's a one-time thing. It's not going to increase it. It's not going to increase earnings quality. Earnings quality likes consistency. Reduces earning quality by distorting sustainable earning. Yes, between A and B, I can take out A, keep B. It's going to reduce earnings quality because it's going to distort sustainable earnings, because I want sustainable. I want the earning that's going to stay from year to year, not that one-time contract that Caterpillar got from the Brazilian government. C, does not affect earning quality as gain are reported. No, yes, it does, because it's a one-time thing. Enhances earning quality. No, if the gains are reoccurring. Yes, if the gains are reoccurring, but then it's a one-time gain. Therefore, it's not. Therefore, it reduces earnings quality by distorting the sustainable earnings. Now, if the company knows this, they will need to disclose this in their notes. And analysts would ask, is this sustainable? And if they say no, then when you're analyzing the company, you will take that into account. But what happened is they reduce the quality of the earnings, especially if they don't disclose it, because now you're thinking, the revenue went up, there's a chance it could happen next year, but there's no chance because this was a one-time contract. What should you do now? To reinforce your knowledge, go to Farhat Lectures, practice additional MCQs. That's going to help you whether you are studying for your CMA, CPA, finance, accounting courses. Invest in yourself. Farhat is always here to help.